All right, this is Vic's Financial Strategy, and lecture number 2 is going to be going over liquidity, what liquidity is, how to understand it, and the difference between liquidity in stocks and options. So what is liquidity? How easy it is to get in and out of a stock. Not talking stocks for a second, something that's illiquid would probably be your house because it takes some time to convert that into cash. But stocks are generally very liquid. But to go a step further, how can we understand the difference in liquidity between different stocks and options? So for stocks, we're going to be looking at volume, and for options, we can look at bid and ask spreads and open interest. Now, what is volume? Volume is how many times the stock has traded within a given amount of time. Usually we're talking about a day. So if we look on the daily candles, I'm going to flip over to the D for day, and each candle represents a day. We see that on today, 111 million shares were traded. And you can see this here at the top. So if I go over to this big day right here, we see that 164 million shares were traded. But today was 111. And if we look at the 1 minute, we can also see the volume for each minute. So we saw that the most amount of volume was at the end of the day. And this is pretty typical for stocks as the market closes. So Apple is a good example of a very high volume stock, but it's also a very liquid stock because of the bid and ask spread. We'll go over that in just a second. So what are examples for high volume stocks? Well, Apple, like I just said, was an example of a stock that has high volume. Usually S&P 500 stocks are going to have high volume. FANG stocks, which from FANG to TANG, as I like to put it, Tesla, Amazon, Netflix, and Google, or Tesla, Apple, Netflix, and Google. Large tech mega cap stocks are usually going to have high volume as well. Some low volume stocks are going to be the dead penny stocks, the dead pharmaceutical companies, basically all stocks that don't have a major spotlight shining on them, causing for a good amount of attention. Now, what are some examples of high volume trading periods or moments when stocks tend to see a little bit more volume? During economic news, we're going to see a lot more volume. So that can be anything like CPI data releases, FOMC meetings, Fed minutes, but also breaking news. So stuff that's kind of unforeseen, like China invading Taiwan. Hope that never happens. Russia invading Ukraine was a pretty high volume day. But also market open and close, we'll see a lot more volume, and expiration dates. Fridays, we'll see a lot more volume because a lot of options expire Friday. But more specifically, the third Friday of every month, we'll see a lot more volume on options as they close. Now, before we shift our focus to open interest, I do want to talk about the bid and ask spread. So Apple is going to be our main example of a very liquid stock. This lesson is on liquidity, but I need to bring up the bid and ask spread. So if we take a look at the bid and ask spread for Apple, we see that buyers are stepping in here and sellers are stepping in here. The bid is all of these buy orders. The ask is all of these sell orders. We see that there's a lot of volume at the bid at 147.8. We also see that there's not too much volume for sellers until we get to around 149.58. We see 1,000 shares willing to be sold here, and we also see 15,000 shares willing to be bought here. This is the after hours, so this is not typical level 2 order book quotes. Usually during trading hours, we're going to see a lot bigger orders. We're going to see a lot more flow come in here to the level 2 order book, and we'll see a lot more volume increase. Let's flip on over to skills. We'll look at the bid and ask spread. For skills, we see that the spread between the two is very high. So we see buy orders here at 88 cents and we see sell orders here at $1. The difference between the two is 0.94. So this is more of an example of an illiquid penny stock. Now let's talk about options really quick. Options, you can measure liquidity with open interest. What is open interest? It is the amount of times buyers and sellers meet, the number of open bets on the market. So let's flip on over to Apple and let's look at this options chain right here. Let's say I'm feeling very bullish on Apple and I think that Apple is going to go up and surpass 150 by next Friday. So let's say I pick out the option contract here at the $150 strike price. It's a very liquid option to choose from because we see that the difference between the bid and ask is only pennies. It's only a difference of 2 pennies, so the mid price is going to be very, very close. As you go further out, we're gonna see a lot less tighter bid and ask spreads, but even Apple will have some pretty tight bid to ask spreads and will be very, very liquid. Also, we see that here at 150, Apple has higher open interest. Remember what I said about open interest? It is when buyers and sellers meet, and it's the number of open bets that are out there in the market right now. We're sitting at 11,000. And if we compare this to other option contracts to choose from, we see that the open interest is significantly lower. The top two is going to be the $150 strike price and the $155 strike price. These are some two big psychological levels right here. It's not a surprise to me why these ones have high open interests. Now let's say I bought a call and then I sold a call, and the person I sold it to was buying to close. That would take away from the open interest. Now, why do we care about liquidity? Well, let's bring up our friend's skills over here. This is our example of an illiquid stock to choose from, an illiquid options chain as well. We see that the open interest is garbage. Only 7 people have open bets on this option right here. We see that the bid and ask spread is kind of wide. It's a difference of 6 cents. If we were to enter this trade, we would be experiencing some slippage. So to get in and out of this trade might be some difficulty, but also the implied volatility is very high. So overall, this is just not feasible, not ideal trading conditions for options. That's why it matters to pay attention to illiquid option chains and liquid options chains, because it's going to be a lot easier to day trade. So this is where it all comes together. This is where we are looking at open interest, we're looking at the bid and ask spread, and we're looking at unusual elevated levels of volume. This is why liquidity matters, and this is why you trade liquid stocks, but also how you could take illiquid options chains and use this for future calculated bets when you see big whales start to accumulate almost $1 million worth of puts. So this is a topic for another time, talking about options flow and looking into options flow data, looking at what bigger players are doing, looking at the bets they make. That's a topic for another time. But that is a brief summary of liquidity, volume, open interest, and bid and ask spreads. Continue to follow this channel for more. Thank you so much for watching. Stay tuned for the next one.